Two macro charts can quietly frame every trade you take: the dollar and the 10-year Treasury yield. Used honestly, they are context, never a signal. So let us read them together. Let me show you a chart you are probably not watching. On top, the dollar index. It simply tracks the dollar's exchange value against a basket of major currencies like the euro and the yen. Down below, on the very same days, the broad stock market. Now here is the relationship people talk about. A rising dollar is often a headwind for stocks. It can squeeze the foreign earnings of big companies, and it tends to firm up when money is drifting towards safety. But notice the words often and tends to. What you are about to see is an association, not a law, and not proof that one move caused the other. The very same headline can push both at once. So let us just look at the record. Across this window, the daily closing returns of these two were inversely correlated at about minus 0.5. To make that visible, here are a few of the days where the inverse showed up most clearly. And I want to be honest with you. These are the strongest matches in the sample, hand-picked because they are obvious. On this day, the dollar closed lower and stocks closed higher. Here, the same pairing again. And here, the dollar closed higher while stocks closed lower. The minus sign is the whole point. Over this stretch, when one tended to close up, the other tended to close down. Read it as context, a tilt in the backdrop, never as a guarantee. Traders have nicknames for these two backdrops, and they are worth knowing. Look at this stretch, which I picked because the dollar drifts lower while stocks climb. When the mood is confident, money often leans away from the safe dollar and towards stocks. People call that risk on. Now, this other stretch, again selected because it leans the opposite way. The dollar firms up while stocks slide. When the mood turns cautious, money often moves the other direction, towards safety. People call that risk off. These are simplified labels for a messy reality, not switches that flip cleanly on and off. But the rough idea holds up often enough to be useful as context. Risk on tends to favor the dollar lower and stocks higher. Risk off tends to favor the dollar higher and stocks lower. Before you take a trade, it helps to know roughly which of these backdrops you are sitting in. The dollar is one piece of the backdrop. Here is the other, the 10-year Treasury yield. Think of it as the going interest rate on a 10-year government bond, an asset with comparatively low credit risk, though, to be clear, not no risk, because its price still swings with rates and inflation. Up top, that yield. Down below, the tech-heavy side of the market, which tends to be the most sensitive to it. Here is the idea. When that yield climbs, a relatively safe bond starts paying more, and at the margin, that can make an expensive growth stock a little less attractive. So money sometimes rotates, and the priciest names often feel it first. Again, a tendency, not a rule. Look at the record over this window. The daily returns were inversely correlated to, even a touch tighter than the dollar in this sample, and you can see the reading on screen. Here is a day the yield closed up sharply while tech closed down. And here, earlier, a similar pairing. And it runs the other way too. Here the yield closed down and tech closed up. So as a piece of context, a rising yield is often a headwind for stocks, especially growth, and a falling yield is often a tailwind. Now, a crucial caution, because this part gets oversold. This inverse is a tendency, not a law, and plenty of days simply break it. Across this very window, the dollar and stocks closed in the same direction on roughly a third of the days. Here is one of them, where both just closed higher together. No seesaw at all. So why does it break? Many reasons. Shifting expectations about growth, inflation, or policy can move everything the same way at once. And the strength of this link is not even fixed. Measure it over a longer stretch, or in a different market, and it drifts, sometimes firmly inverse, sometimes near zero, occasionally turning positive for a while. So treat any single correlation as a snapshot, never a constant. The honest takeaway is simple. Do not treat this correlation as a switch you can trade blindly. Use it as one piece of context, hold it loosely. And the moment it stops holding, notice that because the backdrop has changed. So how do you actually use this without fooling yourself? Carefully and as context, not as a green or red trading light. One important caveat first. These are completed daily candles. You do not know how the dollar or the yield will close until the day is over, so this is not a same day entry trigger. Where it helps is the bigger picture, the backdrop you carry into your trades. If the dollar and yields have been drifting lower, stocks have a gentle tailwind, and your long setups are leaning with the current. If the dollar and yields have been pushing higher together, that is a headwind, and a breakout is fighting that current. Look at this stretch, where the dollar firmed up and stocks struggled into it. A trader who only watched the stock chart had no idea this backdrop was even there. The point is not to skip the trade automatically. It is to size your conviction to the backdrop and to never be surprised by the bigger picture leaning against you. Let us put the backdrop on one screen. Two gauges, the dollar and the 10-year yield, read together. When both are drifting lower, the backdrop is supportive, and within this sample, stocks tended to lift, the wind roughly behind you. When both are pushing higher together, the backdrop is a headwind, and stocks tended to struggle, the current against you. And often, one points each way, a mixed backdrop, which is exactly when you stay humble. And if you ever wanted to act on this, treat it as an idea you still have to test, never a finished rule. You might, for example, use the prior day's completed picture to set a small bias. But you would have to prove that actually improves your entries and your results across many trades and many market moods before trusting it with real size. None of this is a signal that fires on its own. It is context. The setup on your stock still does the deciding. The dollar and the yield just tell you, roughly, whether the broader tide is helping or fighting you. In a sample like this one, let us lock in the honest version. First, the dollar tracks its value against other currencies, and the 10-year yield is the rate on a low credit risk government bond. Second, in this sample, both tended to move opposite to stocks, an association, not a proven cause. Third, when the dollar and yields drift up together, that is often a headwind, and when they drift down, often a tailwind. And finally, this is daily context for your bias, not an intraday trigger, and never a guarantee. So read the backdrop, hold it loosely, and let your actual setup make the call. Once you keep half an eye on the dollar and the yield, you have a rough sense of the backdrop your trades are moving through. It is not a magic signal, and it is not a proven edge. It is context, nothing more. Read the backdrop, but let your own tested setup make the call. If this breakdown helped you, do me a favor and subscribe to NY Trade Studio. I will see you in the next one.